Yeah, well, I think there's I guess not as good short-term news, but better long-term news. So I think it looks like we're a bit ahead of ourselves. So maybe that's not a surprise given like what you said, which is it's really been a phenomenal rebound. But that being said, even if you just say, hey, look at those rebounds post really no recession, you still typically are up about 28% a year out. So that's still a decent, I mean, it's still a very good upside when you look at it that way. And certainly it could be, there are a lot of times it's higher than that. There's only one time where you weren't up a year out from now, if you think about that, we're up 19%. So, I guess short term, maybe you see a little bit of bumpy consolidation here, but longer term, I think it still looks good.
I would imagine, Bill, that you got calls from your clients in December that were afraid. They were scared, right? What should I do? You talked them into staying in the market as they should have. Are they now calling you and saying, Bill, you were right. I stuck with it, but now I'm up a lot. What do I do? Should I trim some stock exposure?
Yeah, and I don't think it's necessarily time to trim. I would say probably time to be a little less aggressive in some of the more cyclical areas. Industrials have had a heck of a run. We liked them, still, like them a bit, but maybe, move over to a little less cyclical. I'm still living in Texas, so, Houston. So I still like the energy patch. They haven't bounced back as much, particularly the integrated side where, you've got a nice big fat dividend to give you a little bit of cushion along the way.
Yeah, but listen, in fact, I'm flying into Houston today, Bill. I love the city, but I love oil and gas, but it's been a tough market. I mean, it's wiped out investor returns in the last decade. How do we stay positive on it?
Yeah, I think you have to look, the key is, I particularly, like I said, focused on the integrateds, but particularly on the ones that are really focused on shareholders. So in terms of generating cash flow and return on capital versus just production. So, for a long time it was, we just want to maximize production. Maximizing production does not necessarily maximize earnings. In fact, it did not. So I think that's the real key to look for is good stewards of capital. And I think a lot of the large integrateds, even like an Exxon Mobil has certainly even made some, I think, really good strides in that direction. And you've got an over 4% dividend yield there.